Sensitivity analysis is a way of analyzing the impact of upcoming changes in a financial forecast. By changing different variables, such as cost of goods sold, sales revenue, or interest payments, a financial analyst can pinpoint which measures have a significant impact on the pro forma statement. Looking at the changes to those variables that are significant allows the business to focus on those areas as opposed to measures that have little effect on the bottom line. It also quantifies the impact to net income if an assumption is not accurate. Sensitivity analysis starts by building a business case. A business case is built using historical and current data to help predict future changes to cash flows. Performing a sensitivity analysis involves 4 qualitative steps. First, we must identify the key variables. These variables will relate to goals or expected changes. For instance, an increase in sales revenue, reduction in cost of goods sold, or changes to marketing expenses. A well-developed business case will show what % of revenues and expenses change relative to the values that are chosen. For instance, how the amount spent on marketing drives a change in sales revenue. The next step is to determine a range of values. This may include activities such as coordinating with subject matter experts on upcoming changes in the industry or reviewing historical sales trends. The range of values identifies the upper and lower limits of change expected. The third qualitative step is to determine the method of variation for the variables. This can involve using specific values for each variable or calculating as a percentage of change to see the effects. Once those steps are completed, the results need to be analyzed to look at the various impacts and summarized for decision making. The quantitative steps in performing a sensitivity analysis start with establishing a baseline. A baseline is developed by looking at finances over a period of time, such as monthly, quarterly, or annually. Once the baseline is established, multiple scenarios are developed by making changes to key indicators. The results of each scenario are reported as a separate set of outputs. These results are then analyzed to determine the sensitivity to change for each variable. This is accomplished by using tools such as moving average, regression analysis, or smoothing forecasting. These tools will provide information that a financial analyst can use to interpret which variables have the greatest impact on net income. Once the analysis is completed and interpreted, the scenarios and key variables identified are presented to decision makers for transition to operational plans. Sensitivity analysis is an important tool in forecasting operating budgets. This analysis shows which indicators are important to track to achieve desired financial results. This information can be used to set goals, such as adding new customers or optimizing the workforce. Sensitivity analysis provides a means to focus business decisions on those activities that provide the greatest value in achieving the financial objectives of the business. Upcoming changes can involve new projects. In addition to sensitivity analysis, risk must be considered in capital budgeting. Risk and return are directly related. The more risky a project is, the higher the return required for that project. Risk is incorporated into capital budgeting by adjusting the discount rate used to calculate cash flows. Increasing the discount rate allows the project evaluation to account for the risk of potential losses. Projects can be evaluated by incorporating the discount rate through the discounted payback period, net present value, which is based on discounted cash flow, or the modified internal rate of return, which accounts for risk by adjusting the weighted average cost of capital. Values used to select or reject potential capital projects include shorter discounted payback period, higher net present value, and higher modified internal rate of return. Understanding how key variables can affect net income and accounting for financial risk are important factors to use in forecasting and business planning.